Megan, we see stocks not only breezing through the bad economic data, but then rallying on updates and progress on the fight against coronavirus. It seems this market is still very much taking its cues from the viral front. Is that a good thing, or are markets getting ahead of themselves before the economic pain still works its way through the economy?
Well, I think it's definitely a good thing, and any good news from the viral front is definitely going to result in, some moves in the stock market. I think that the negative news has been expected. It's going to get worse before it gets better. We've known that. But the viral front is the one thing that they've just been waiting on, some positive news. And we've got some of that now. We've got a little bit of an indication on how we can start opening up the economy again.
Yeah. Right now, the Treasury market seems to be casting some serious doubt on what's happening in stocks this morning. We've gone through different periods of stocks and bonds and their correlation for a long time. It was both rallying together. Then that broke pretty severely this year as the coronavirus situation unfolded. How do you consider the two right now? Or can we expect them to still be diversifiers and bonds function that way? Or are we going to have more high correlation events like we had in mid-March?
Well, I think when you have the central bank that's being such a big part of the bond market right now, it's very difficult to look at history and try and gauge on how stocks and bonds should move in times of crisis. The situation with the central bank and what they're doing in the intervention, that's going to constantly have the demand side for the Treasuries and also the bond market. So that should keep a lid on a big increase in interest rates. The other part of the bond market right now is I think that when you see energy and oil prices under such significant pressure, that it's also resulting in a decline in inflation expectations. And when you have declining inflation expectations, it's very difficult to see yields back up in that type of an environment.
It's interesting because I get the logic here. The Fed's a buyer of Treasuries. They've been a buyer of Treasuries. The market as a whole and investors, as we've seen through flow data the past year in 2019, were also huge buyers of Treasuries. But with the yield so low, and now the Fed also buying high yield, investment grade, and municipal bonds and everything else they're doing, if I'm a bond buyer, why would I go for Treasuries with the lowest yield if I can feel safe because the Fed's got my back and even higher yielding stuff?
Well, here our recommendation is we don't necessarily recommend buying Treasuries because you're right, yields are so low, you have such interest rate risk there. We would prefer to be entering those parts of the market in fixed income where the Fed is offering support. Investment grade bonds,
Gotcha.
Municipal bonds, bank loans. These are investments that we would focus on right now.
Interesting. And when is it in terms of allocation versus stocks, is that just portfolio specific depending on strategy? Or when you talk with clients, is there a clear kind of breakdown where you want more within fixed income or more within stocks? What seems like the best bang for your buck right now?
Well, the risk objective is always the number one concern that we take into account. But right now, we've been gradually adding into the equity market in this bear market. Coming into this, we were basically neutral on U.S. large cap equities. We've been gradually adding some exposure there. And then within fixed income, we've been looking specifically at those credit sectors that really blew out in the past few weeks and offer an attractive risk-adjusted return.
Do we think that our credit spread blowout that you mentioned, the worst is over? Does it look secure with the stock market bouncing, credit spreads coming in, the big move in bonds up off the low? Does it seem like the worst of this storm is over, Megan?
From a credit perspective, you never can say the worst of it is over, but we do think that with what the Fed is doing, that it is taking a lot of that risk of default off of the table, and spreads and credit. They were pricing in a significant default type of a situation going forward. But with the Federal Reserve and then the programs that they've been putting forth, this does kind of put a backstop there on some of the default expectations.
So with stocks right now, tell me what looks attractive. We've got tech that has been very strong, banks that are just getting crushed. I know that so many right now are looking at bonds and look at banks and they say this bounce that we've seen in the broader equity market is due to fail because such important parts of this are not taking part in the rally. where do you side? I mean, should we believe what's happening in tech? It seems like, according to the NASDAQ, that there's a whole big section of this economy that's not even fazed by coronavirus.
Well, it's also a big section of the economy that's being used the most right now, if you think about it. Technology definitely, and that's what's running the world right now is different, technology. But there's one thing that'll come out of this when the market does sustainably move higher. The things that have been beaten down the most will be those ones that come back. We still feel strongly about banks for the long run. The Federal Reserve and the interest rate situation is a challenging environment for banks right now, but there is still room, I think, for improvement. And I think they're pricing it's pricing in a worst case scenario right now for financials. So we still think there's value in financials if you have a longer term time horizon.
Are we seeing right now that with the Fed at play, though, the market just runs back to the kind of growth stocks and the high return companies? Are we ever going to get a solid value bounce that actually lasts in this market?
Once you get the energy and financials is what's completely driving the value side down. And I think that once energy starts to find a bottom, oil prices find a bottom, then there's room for those energy companies to rally too. So I think if you can get some stability in the interest rate environment where interest rates aren't consistently moving lower, you get some stability in energy prices, that's a good environment for both financials and energy companies. And they've been beaten down so much that there's a lot of room for them to rally.
Crude oil this morning getting beat up again. Had some in trouble.